Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Ontario, Canada. We have a mission to become the Google map for hardworking Canadians seeking financial freedom. Today, we're going to share with you 5 simple strategies you can use to split income to lower your overall family tax bill. Before we dive deep into these strategies, in this video, make sure you subscribe to our YouTube channel and turn on the little notification button so you can get notified when we share the latest tax tip. With that, let's get started. Before I discuss these 5 strategies to lower your overall tax bill, it is important to have a brief discussion on why income splitting is the key to lower your overall family tax bills. Canadian personal income tax system is a progressive tax system. What it means is that the more income you earn, the more tax you have to pay. Let's say you earn $200,000 salary income. The way your personal taxes are calculated is based on different tax bracket and the respective marginal tax rates. The first $10,880 that you earn in Ontario in 2021, you pay no tax at all. The $2,908 income you earn between $10,880 and $13,808, the first tax bracket for Ontario residents, you pay 5% tax, which is equivalent to $148. We then keep going with the same calculation until we reach the income level of $200,000. In that case, when you make $200,000, you would need to pay a total of $69,000 of income tax in 2021. Yep, that is a lot of money. But there are some key learning lessons here. Every Canadian tax resident has this exact same set of low marginal tax rates every single year. If you are able to spread this $200,000 of income to be reported by 2 taxpayers, each reporting $100,000 of income, each person is then responsible to pay about $23,454 of income tax. Total taxes for the 2 people combined together is about $47,000. Reporting $200,000 by 1 taxpayer, that person has to pay $69,000 of tax. Reporting $100,000 each by 2 taxpayers, total tax payable is about $47,000. So you can see tax saving by spreading the income to 2 taxpayers is about $22,000. So tax planning is essentially about splitting your income to as many people as possible so that you can utilize the low marginal tax rate and apply them accordingly. If you don't have that low income spouse, another strategy is to split that income with your future self, since you get to have a fresh set of low marginal tax rate the year after, year in, year out. Now that we have a basic understanding of how the Canadian tax system works, we can then discuss the 5 simple strategies you can use to split income with your low income family members. The first one is using RRSP and spousal RRSP. High-income earner can make spousal RRSP contribution, assuming that the spouse is earning less money. Using the above example, if the high-income spouse makes $200,000 annually and he contributes $20,000 to the spousal RRSP, he is eligible to deduct that $20,000 contribution and save $20,000 multiplied by 48%. Highest marginal tax rate equals $9,638 income tax. Now, the low-income spouse could then potentially withdraw this RRSP contribution made by the high-income earners 3 years later, assuming there is no movement in the spousal RRSP plan, and report this RRSP as income at a much lower rate. Of course, a similar strategy can be applied for yourself to split income with your future self, especially for investors who are planning to quit their full-time job in the near future. Contributing to RRSP and withdrawing from it when you earn low income can be an effective way to lower your overall tax bill. The second strategy is tax-free saving account. We all know the benefits of contributing to your TFSA account. Investment income you earned from TFSA can be tax-free for the most part. If you don't know much about tax-free saving accounts, I have been creating a series of YouTube videos focusing on TFSA. Make sure you check out these videos to get a better understanding. If you are the high income earner, you can make TFSA contribution to your spouse or family member's account. Income earned in their TFSA account is not attributed back to you personally. For someone who has never contributed to his or her TFSA before, he or she can potentially contribute as much as $75,500 into his or her TFSA account for investment purpose. That's a lot of money that you could use for investment to earn investment income tax-free. The third strategy is spousal loan. High-income earner can lend money to the low-income spouse, who in turn uses the borrowed money to invest and earn higher income. Investment income earned will not be attributed back to the high-income earner as long as the taxpayer set up this arrangement legitimately and follow through with all the compliance requirements. Currently, CRA requires this high-income earner to charge at least 1%, the prescribed rate loan as set out by CRA, as the interest charge on the loan. Yes, the high-income earner would have to report this 1% interest income, but the low-income spouse makes 5% to 10% return on investment, deducts a 1% interest expense paid to the high-income earner, and pay taxes on the spread at lower marginal tax rate. And you are able to split income with your low-income spouse legitimately. No attribution rule will be applied. The fourth strategy, using family trust or corporation for income splitting purpose. Income splitting using family trust and corporation isn't nearly as easy as in the past, but there are still ways that you can split income with your family members using these two vehicles. Spousal loan arrangement can still be made to the family trust or corporation to allow for income splitting purpose. Family trust or corporation invests the funds for higher return, pays 1% interest to the high-income earner or business, and the net investment income can then be reported in the hands of the adult children at low marginal tax rates. The fifth strategy is pension income splitting. If you are receiving pension income, you might be qualified to split up to 50% of your pension income with your spouse. Generally speaking, you must reach the age of 65, but your spouse can be younger. On top of the savings from reporting a portion of the income from lower income spouse, for the lower income spouse who's receiving the pension income allocated by the higher income spouse, if he or she is also over the age of 55, he or she will also be entitled to an additional $2,000 tax credit, which is equivalent to $400 tax savings. Income splitting isn't necessarily for the wealthy. If you look hard enough, there are always ways to split income legitimately and lower your overall family tax burden. If you like the video, make sure you give us a thumbs up and click the button to subscribe so you can stay informed of the latest tax tips. If you have any questions, make sure you ask them below and I will get back to you personally. Thank you so much for watching.